Hello everyone, welcome back. Patrick here. Well, are you ready for a little distraction from the GameStop drama? Let's go back to the typical Sunday review. This week you guys have voted for CLII, that is going to be merging with EVgo. Thank you so much for voting. I'm totally shocked that 1,200 of you almost have voted, so that makes the channel a bit more interactive. I really appreciate it. So, as usual in this video, I'm going to look and see what the company was doing before. What are they planning on doing after this merger? Like, what's their execution plan? The valuation and revenues, and then how I'm going to be playing this. You guys know I've been fairly skeptical about these types of charging station plays, even though, honestly, Chargepoint has done very well. I was wrong about it, but overall, I'm still a little bit skeptical, so we'll see if they can change my mind. So let's get started. As usual, please like and subscribe. It really helps out. And also, if you want to take advantage of SoFi's $50 free that you can get when you open a money account or an investment account, I have the link in the description and in the comments. Thank you so much. Alright friends, let's get started with EVgo. This is the latest electric vehicle charging station company to come into the market at a SPAC. Right now we have Chargepoint and we have EVbox. Well, this is the latest one. EVgo does things a little bit differently. Right now they are really focused on the fast charging stations. So their slogan is charge in minutes, not hours. I think it speaks volumes. They're really targeting the customers that are going to need to charge very rapidly during the day to continue their operation. So let's say that you're driving to another state to visit family, or let's say that you're an Uber driver that actually needs to charge during the day, like very rapidly. You can't go and sit at a charging stations for 4 hours while your car charges. You need to get done quickly so you can go back and make money by driving people around. So this is what the company is focusing on. One angle that I like before we get into the investor presentation is the special offers that they have. They have managed to partner with a few of the big OEMs. We'll talk about it in a minute, but they're going to be offering charging credits for some of the cars that people purchase. So let's say that you go and buy a BMW, they might give you $100 or $500 in charging credits at EVgo stations. This is a clever way for them to attract potential customers because, like, first of all, you're going to go and use your credits, and once you've done that, maybe you'll go back and try it again, like when you need to. If we look at their network, currently they have 818 locations with 1,412 charging stations. So the company is still fairly small compared to their competitors, right? But as I mentioned, they're kind of going a different route than the other ones are. So currently they are mostly located on the West Coast, of course the Northeast and Midwest, plus you have Southeast and some in Texas. But they do plan on expanding very rapidly. Another one of their big partnerships that they got, which is going to help them tremendously, is with General Motors, which you guys might have heard recently, plans on transferring all of its production over time into electric vehicles. Well, so they do need partners in the charging stations, and that's going to be EVgo. So they're going to help them triple the size of their fast charging network. This is going to be great for both companies, of course. And again, as we were talking about earlier, they might be able to get, let's say, a $200 credit or $500 credit when they go and charge at EVgo stations. So there's great synergy between these companies, and this is going to really help EVgo in the future, since right now they're smaller than their competitors. If you look at the basics of a transaction, there is going to be $400 million in PIPE, and the company at the IPO price of $10 was underwritten at $2.1 billion. It's risen since then. We'll talk about it later in the valuation section. So one of the things that we need to look at is that they are going to have $575 million in net proceeds. So this includes also the money from the SPAC. And through this money, they plan on being able to deploy all of those charging stations and like have their operations funded until 2026, which is when they think that they'll finally get to cash flow positive. When we analyze these charging station companies, I do think that one of the most critical aspects is going to be the partnerships that they enter into. I feel like not a lot of people look into that enough. This is what's going to make or break these charging station companies. So if we look at EVgo, they seem to be very, very good at doing this. Let's look at the OEMs that they're partnering with. You have BMW and Nissan that are going to give the credits. Nissan is $250 so far. GM is going to help them build 2,750 charging stations. course, that's great for the company, tripled their network. Then you have Hyundai, Kia. And as far as I understand, I don't own a Tesla, so correct me if I'm wrong, but Tesla, EVgo right now is the only fast charging station that has an adapter for Tesla drivers. So this is one of the benefits for them. Now, one of the components that people don't look at, and I think is going to really differentiate them, is the real estate partnerships. Because it's a great thing if you can build these charging stations, but you're not going to put them in the middle of nowhere. They have to be in high traffic areas. And for that, you're going to need mostly retail partners. So companies like Sheetz that currently delivers gas, right? So you have Wawa, Safeway, Walmart, Whole Foods, Walgreens, Chevron, right? All of those companies that own a lot of real estate right now, and land, of course, parking lots. This is what's going to really help EVgo, is if they can get in with these guys, then that's going to help them get prime locations for their charging stations. One of the things that we really disagree on, and we're free to disagree, I mean, it's not a big deal. One of the things that I did not like about Chargepoint is the fact that a lot of their charging stations are very, very slow. And I personally never believed that on a large scale, people are going to go to Walmart and let their car charge for 6 hours. It's just not going to happen. People want to go grab a bite for 15, 20 minutes, come back, their car battery is full, and then they go on their merry way and do the rest of their business. So that's what I feel is going to be a big factor for EVgo if they're going to be successful, is these partnerships that they're going to be able to get with all of these retail players. Now, they have the fleets. We talked about it. Uber and Lyft is going to be one of the big source customers for these companies. Then you have the local governments and maybe the federal government. Who knows, right? A lot of people have been talking about the Biden administration and building hundreds of thousands of car chargers. Well, this company might be tapped into, and that's going to be very helpful for them. Let's look and see how all of this works together to bring revenues for the company and what the unit economics are, because they really are precise in how much it costs them to deploy these units and how much money they make. I really like that. I feel like the company is very conservative with their numbers, and this is great for the shareholders. But first, their partnership with Lyft really helps those numbers. Right? So each Lyft driver drives at least 200 miles per day. They have a SUV or a big sedan, so they are going to need those DC fast chargers. Each of them, according to their statistics, increases the utilization by about 2 to 3% for each charging station. So they had a pilot program with Lyft in 3 different metro areas, Atlanta, Denver, and Seattle, since 2019, right? And the numbers are, in my opinion, staggering. So with 100 Lyft fleet vehicles, this brought the utilization from 5.87% to 11.28%, and then per month, 61,000 minutes to 127,000 minutes. So this is just with Lyft. But what about Uber partnerships? What about scaling this nationwide? This is going to have a huge impact on the company's profits eventually, right? So in the beginning, they are going to be losing money every time they install one. They split this in the California projects and non-California, because in California, I'm guessing that they are getting a lot of money upfront to install these, so it helps them lower the cost. If we look at it, you guys will see, I mean, it is pretty interesting, right? It costs them about $260,000 to install. So it's not a cheap thing or anything, or at all, right? It costs them a lot of capital to deploy these. And then the first and second year, they're losing money. Not really losing, but what I mean by that is they haven't recouped their investment yet. So the first year with 8.9% utilization, which is lower than with the Lyft partnership, that's what I was saying. They're very conservative with their numbers. 265,000 in revenues. Then when you subtract the operating expenses, gives them a positive EBITDA of 85,000. So it costs them 260, and then the first year they're only up 85. So it takes more than 1 year for them to recoup their investment. It is taking them 2.5 years in California. Now, the lifespan for these charging stations is 10 years, but the company is only calculating the first 7 years. After that, it's all going to be profits minus the operating expenses. So year 7, when, like in 2027, let's say, we can assume that the utilization is going to be higher, more people are going to have these electric vehicles. So the utilization jumps to 22.9%, revenue is 470,000, and then 180,000 positive EBITDA per charging station. So this is great. It translates to a 7-year unleveraged internal rate of return of 35+%. payback period, we talked about 2.5 years, and 50% cash yield. So these are great numbers. I mean, yes, it is a lot of investment up front. That's the downside to companies like these that have physical products. But if you can be patient and wait it out over the years, that's when the cash flow is going to start coming in. So there's no point in really looking at a lot the non-California project. Right now, they're working on smaller stations, right? They don't have the 4,175 kilowatt. So because of that, it's going to cost them a little bit less to deploy them. But at the same time, they're not going to be making as much per charging station, right? So 150 after year 7. It takes them 3.5 years to break even with those. So the return is a little bit smaller. But overall, these unit economics, I mean, it makes sense if they can generate those returns with 22.9% is not out of the ordinary if you're thinking about really prime retail locations like a Walmart parking lot, like current gas stations and stuff like that. I do feel like these numbers are conservative and realistic. I feel like I've done a good job at being positive and looking at the upside with this company, giving them a chance to convince me to invest with them. But as usual with these charging companies, when I look at the revenues is when I just want to pull my hair out, especially when I tell you guys the valuation, you're going to fall off your chair. So 20 million in revenues in 2021. If everything goes well, they think they can get to 1.3 billion in 2027. This would bring the chargers from 2,211 to 16,212, and the revenues from negative 112 million to positive 185 million over those next 7 years. So this, again, the problem is the capital expenditure needed. You just need to spend so much upfront to build a network, which all of these companies that build physical products, right, that's the issue with them, is that they're going to be cash flow negative for years. And in the meantime, do you guys want to go on this adventure with them where you're not going to see a real profit with this company until potentially 2026? That's a long time from now. There's so many more companies that are currently already profitable that I can park my money in. So you really have to believe in the vision of this. It's almost like a calling for some people. Sometimes you invest in something because you really believe in it. It's not just about the money. Well, that's how I see these companies. It's not about making the maximum amount of profits over time. It is because you really believe in electric vehicles and charging stations, because otherwise there are other companies to invest in my opinion. All right, guys, we're almost done, but the last piece of the puzzle is the valuation. So after the merger, there is going to be 263.1 million shares. The share price as of me filming this is 20.9. And then if you subtract the amount of money that they're going to have in their bank account after the merger, this gives us a valuation of 4.9 billion for this company currently. And this is fairly outrageous, let's be totally honest. Yes, the company does predict that they're going to have a lot of growth over the next several years, but when you compare it with some of their competitors is when it gets a little bit how are these SPACs so high right now? I mean, it's not normal in my opinion. Even if you want to look at them not just as value plays, it's still a little outrageous. So valuation for EVgo 4.9, Chargepoint 11.1, Blink 2.05, and EVbox 3.1 billions, right? So I added the revenues and then I added the valuation divided by the 2021 revenue, which doesn't include their potential growth in the future, right? But for now, we're going to look at how they stack up one against each other in 2021. And then I also have the, not Warren's price, this is wrong, but the price of the shares for each of these companies. You'll be able to look and see that ChargePoint at 38, Blink at 49, and then EVbox at 25. EVgo is the cheapest when it comes to the share price, but if you compare it based on valuation versus their revenues, they are much higher than the other ones. So you can see it here. Valuation, of course, ChargePoint is the bigger one of the companies, but then you have EVgo that's higher than Blink and EVbox. So how do their revenues compare in 2021? Well, here you can see that EVgo, the valuation compared to the 2021 revenue is much, much, much higher, completely different scale. between this company and some of the other ones. So Chargepoint, I mean, there's some problems with it. I don't like the fact that they don't really tell us how they're going to become profitable. But aside from that, at least the company does have revenues. Like, they're going somewhere. They have a big network already. So if you compare the two, I mean, it's undeniable that Chargepoint is much bigger and provides a lot more revenues right now than EVgo does. Blink, kind of like in the middle, and then you have EVbox that seems to be the best value of all of those, at least where we are right now in 2021, right? So then you have to account for yourself, well, are they able to go to that 16,000 stations and 1-point-something billion in revenues in 2026, start becoming profitable and all of that? Like, you'll have to compare the growth between all of these companies, which one you think is going to be higher than the other ones. But if I look at it right now, based on what we know currently, I do feel like EVbox is a much better play than EVgo at this point when it comes to looking at the value. Now, currently, as I mentioned, 2090 is the share price. The warrant price looks to be a little cheaper than what you would expect at 5.15. So I do feel like the ratio is pretty good for the warrants compared to the shares. All right, friends, it's time. In the wrap up, what do we think about the company? Does it get my seal of approval? And how am I going to be playing this company? Well, first, I'm going to say that when it comes to long-term play, I'm going to just avoid it. I mean, I don't want to be on this journey. I think that the company has a plan. The unit economics are actually going to work, but it's just when you compare it with other companies, I just feel like I would rather be elsewhere. I like the fintech plays where everything is digital, so they can scale almost infinitely. I gave you another day the example of SoFi. The difference between 3 million users and 30 million users is just adding a couple servers and some customer service. Well, you can't scale very easily with companies like these. There's a lot of upfront costs, and for that reason, I'm not interested in being on this adventure with you guys if you're into this company, sadly. However, when it comes to the short term, like, do I think that there's going to be enough momentum with this company to like make this a momentum play and trade it? I'm not quite sure. I'm going to veer towards no, just because of the fact that right now the market is kind of uncertain. The valuation is fairly high compared to EVbox, as I was showing you guys. A lot of people are invested in Chargepoint. It is possible that they're going to take their money out of Chargepoint after the merger and transfer it into this one. After all, if we look at the chart, I mean, there is a lot of enthusiasm about this company. It jumped from $13 very quickly to a little over 22, and right now it's stabilized around 20.90. Now, with the current situation with GameStop, I don't know when you guys are going to watch this review, but it is very likely that over the next week or two, a lot of these companies are going down. Like, all of the SPACs are red right now, so you might be able to pick this company up a little bit cheaper, let's say at $18. Even the warrants, as I was saying, at $5.15, they're currently not too expensive. So if they drop to $4, then it could be an interesting play short term. But overall, I'm not totally impressed with the company. I mean, as I said, I feel like there are better plays for my portfolio. So for that reason, I'm not going to give it like a seal of approval, but that doesn't mean that there's anything wrong with the company, right? It just means that I think that there are better options. So let me know in the comments what you guys think. This company has been flying under the radar still. I do think that EVbox seems like it might be better value for now. So personally, TPGY is what I would look into. So let me know what you guys think. I'll see you guys next time.